Hello everyone, my name is Ashraf and I will be presenting my proposal for the research project 1 titled Quantitative Study on the Relationship Between Carbon Emissions and Public Listed Companies' Financial Performance. Climate change due to carbon emissions originating from industrial activities are a critical risk globally, even in 2024. The Global Risk Report 2024 still found extreme weather due to human-induced climate change as a significant risk both in short and long term. Global warming has been aggravated due to the anthropogenic acts as the surface has gotten warmer. The carbon emission trend in Malaysia from industrial activities is also increasing on a year-to-year basis as shown on the charts. The call for private firms to reduce their carbon emissions from their operations is deemed one of the major pushes towards climate change mitigation and adaptation in addressing the stark numbers shown. However, there may be justifiable reservations that companies hold when there's uncertainty on their business case for reducing their carbon emissions. This issue proves true in Malaysia as corporate firms being accustomed to traditional conduct of business that is profit-driven and are not adapting fast enough to reduce carbon emissions resulting from their activities. An article by PricewaterhouseCoopers has stated that sustainability and carbon reduction are still pursued from a compliance point of view. This limits the long-term view of integrating sustainable practices into their business model and deters the long-term financial benefits that these companies could gain. Malaysia has declared a target of 45% carbon intensity reduction based on GDP from 2005 level as part of its commitment towards the Paris Agreement 2015. This has been updated by the nation in its Nationally Determined Contribution or NDC. To pursue the commitment, Malaysia has established the National Energy Transition Roadmap or NETR, which becomes the backbone behind meeting its carbon reduction target as part of the 12th Malaysia Plan. This leads to pressure exerted on the public listed firms or public listed companies, or in short PLCs, to decarbonize and reduce their emissions to contribute towards meeting the national target. The PLCs are also exposed to other regulatory and stakeholder requirements. The Malaysian Code on Corporate Governance or MCCG and Bursa Malaysia's sustainability reporting requirements places a responsibility for PLCs to disclose their sustainability practices. This leads to a compliance-driven approach to carbon reduction, combined with lacking regulatory framework results in the slow rate of decarbonisation among corporations in Malaysia. Establishing a relationship between carbon emissions and financial performance is a possible influence for Malaysian PLCs to pursue reducing their carbon emissions and enhancing their sustainability. The positive commercial results that could be attained from reducing carbon emissions may become a big pushing factor for PLCs to pursue the agenda with purpose, moving beyond compliance. Now for the problem statement. Examining the relationship between carbon emissions and financial performance is a necessary study, considering the potential influence over the decision to reduce carbon emissions among Malaysian PLCs, contributing towards addressing climate change. Although research has been carried out on this subject, it mainly focuses on more developed markets such as the US, Europe, Japan, and Australia. The outcomes of these studies vary, with some suggesting a positive correlation between carbon emissions and financial performance, others indicating negative correlation, and some showed mixed results. The context of Malaysia as a developing market with distinct business practices and regulatory frameworks has not been thoroughly examined. Hence, examining the Malaysian context would contribute to its better understanding for PLCs on the commercial benefits of decarbonizing their business and enhance the contributions towards Malaysian climate commitment achievements. The main aim of this research is to analyze the relationship between carbon emissions and financial performance of Malaysian PLCs. The study aims to address two research objectives, which relates to two research questions and hypotheses. Research objective 1 is to examine the relationship between unscaled carbon emissions and financial performance, which leads to the research question, what is the relationship between unscaled carbon emissions and financial performance? And hypothesis 1, unscaled carbon emissions affect financial performance. Research objective 2 is to examine the relationship between carbon intensity and financial performance, which leads to the question, what is the relationship between carbon intensity and financial performance? And the hypothesis, carbon intensity affects financial performance. This is the theoretical framework identified for the study. Carbon emissions, which is the independent variable or IV, will be separated into unscaled carbon emissions and carbon intensity, each addressing research objective 1 and research objective 2. Dependent variable from the framework is the financial performance, involving firm value metric of Tobin's Q, as well as return on asset and equity as a measure of company's financial results. Control variables in establishing the relationship between IV and DV include firm size, growth, sector, location, and ownership type. This study contributes practically, empirically, and theoretically. In terms of policy and strategy implications, by providing data-driven insights, this research could influence corporate policies and strategies in Malaysia. The findings could also assist Malaysian PLCs in aligning their operations with the national targets set under the Paris Agreement and the National Energy Transition Roadmap. It also provides practical recommendations for stakeholders, including policymakers, regulators, investors, and corporate managers on how to leverage carbon reduction strategies for improved financial performance and sustainability. In terms of empirical contribution, it provides evidence in the developing market context. It addresses a notable gap in existing literature by focusing on Malaysia, a developing market with distinct regulatory frameworks and business practices. This study also seeks to establish empirical evidence on the relationship between carbon emissions, both on scale and intensity based, and the financial performance of Malaysian PLCs. In terms of theoretical contribution, the study integrates and expands existing theories on sustainability and financial performance, specifically within the context of a developing market. By testing the relationship between carbon emissions and financial performance in Malaysian PLCs, the research will contribute to the theoretical understanding of how environmental practices can influence financial outcomes. This study employs a quantitative research methodology using content analysis of secondary data sourced from publicly disclosed documents, specifically integrated annual reports or sustainability reports. The research will sample the top 100 PLCs from Bursa Marketplace Index as it provides highest reliability and validity in disclosed carbon emissions and financial results. These companies also represent various sectors to ensure comprehensive and representative analysis. Scope 1 and 2 emissions data will be collected from reports disclosed for financial year 2023 based on the 3-year historical data captured within the year's report. Scope 3 emissions is not accounted for due to voluntary nature of disclosure, and having complete and reliable data would be difficult. Carbon intensity will be calculated via Excel by using a uniform denominator on the carbon emissions data such as revenue or total sales. Financial data from 2021 to 2023 will be acquired from statistical record platform, in this case Refinitiv. This data will then be analyzed using multiple regression analysis to determine relationship between carbon emissions and financial performance. As the sample size is 100, use of PLS or even Excel is expected due to the smaller sample size. The analysis will involve diagnostic tests to check for issues that could affect the reliability of the regression results. Outcome of the analysis would determine whether the hypothesis mentioned earlier can be proven or nullified. That's the end of the presentation. These are the references used within this presentation slide.